We're going to take a look at the 3 easy steps involved in building a cash flow statement. But before we do that, we'll look at why someone might care a little bit about cash and what a cash flow statement looks like. Our cash flow statement will focus on the liquidity of a business by measuring cash inflows and outflows. It basically tells us where the money comes from and shows us where the money goes. There are 3 components of our cash flow statement. There can be operating cash inflows or outflows. There can be investing cash inflows and outflows, as well as financing cash inflows and outflows. Here's a typical cash flow statement. Notice we have cash flows from operations, cash flows from investing activities, and finally our financing cash flows. If we look at our operating cash flows of $900, they weren't quite enough to meet our investing needs of $2,000. So the question then becomes, where did the extra cash come from? And we can look at our financing section of our cash flow statement and see there was a $1,200 increase in long-term debt and an $800 increase in common stock. We borrowed money and issued or sold additional shares of common stock. If we take our $900 from operations and add to it our financing cash flows of $1,500, we had $2,400 of cash coming in, $2,000 of cash going out in the purchase of new plant and equipment, and there's our $400 change in cash. And again, our cash flow statement wants to explain our change in cash in terms of these 3 activities: operating, financing, and investing. Our operating activities typically consist of cash inflows from the sale of goods or revenues from providing service, or perhaps we might have interest income. And then we'll have cash outflows associated with paying wages, buying inventory, paying other expenses such as interest and taxes. Our investing activities will primarily consist of cash outflows for the most part. And again, that's going to be the purchase of fixed assets. That would be the purchase of new plant and equipment, long-term assets for our company. We also might purchase investment securities. We might do that for one of 2 reasons. One, we might have excess or idle cash, and rather than sit around earning very little rate of return, we'll invest it in the stocks, bonds, or perhaps treasury bills. The second reason is, instead of building a new factory, the second way to acquire a new factory would be to purchase the common stock of another company that owns the factory we want. So we could buy another company, and that would be another way of acquiring fixed assets. In this class, we're primarily going to be concerned with cash outflows associated with purchasing plant and equipment. We can also have investing cash inflows related to the sale or salvage of our plant and equipment at the end of its useful life, or the sale of our investment securities if we need to liquidate them to raise cash. Now, from a financing perspective, most firms beginning particularly early on in their life cycle have a need for financing. We need to acquire assets, plant and equipment. We need to build inventory and build receivables. So our question then becomes, how do we finance that? Well, we've got 2 primary sources. We can borrow the money by getting loans or issuing bonds or issuing notes, or we can sell common or preferred stock. So our cash inflows will be associated with debt, new loans, or equity, the sale of stock. Now, the only reason investors or people want to give our company money in the first place is because they hope to get more money back in the future. This brings us to financing cash outflows. We can repay loans, purchase or pay off debts in terms of bonds or notes at maturity. We might repurchase shares of our stock, which we will classify then as treasury stock, or we might pay dividends to our shareholders. All of these will be financing outflows because they involve the return of capital back to the investors. Let's go ahead now and take a look at the 3 easy steps involved in preparing our cash flow statement. The first step is to calculate the changes in all of our balance sheet accounts. The second step involves identifying whether the changes resulted in an increase or a decrease in the firm's cash. And then finally, the third step is to classify or identify the source of the change as being operating, investing, or relating to financing activities. Note, some of our changes in our balance sheet accounts, particularly retained earnings, is going to involve multiple types of activities. Let's begin by looking at why we calculate changes in our balance sheet accounts. We'll begin by taking a look at our accounting equation or our balance sheet equation. Now we're going to make use of a little bit of calculus. Remember having to take calculus? Well, we're going to make use of it a little bit here. Don't worry, because it's a fairly simple application. We've got the little triangle, which means what? From calculus, we know it's delta, or the change. We know the change in our assets has to equal the change in our liabilities plus the change in equity. Our balance sheet has to remain in balance. In other words, if assets were to go up by $800, then our liabilities or equity would also have to go up by $800. And of course, if assets were to go down by $800, liabilities and equity would also have to go down by $800 to keep our balance sheet in balance. Now we said we wanted to focus on explaining the change in cash, so let's write the change in assets. Let's expand that to the change in cash, AR, inventory, and equipment, and we might have other asset accounts, but this will do for now. Since we want to explain the change in cash, we need to take our receivables, inventory, and equipment on over to the other side of the equation, so we need to subtract that amount from both sides. So we have the change in cash will equal our change in liabilities plus the change in equity minus the change in our AR, inventory, and what other types of assets we might have on hand. Let's go ahead and make use now of this equation that explains the change in cash by looking at a few individual or particular accounts. Let's begin with the simple one. Let's say we get a loan. We know this one. Student loans go up. What does that mean for us? That means we have received cash. Now, of course, the bad news is someday we're going to have to repay that loan. And when the loan gets repaid or the loan goes down, that's going to be a use of cash. Let's consider another liability, our accounts payable, when we buy things on credit from vendors. Well, accounts payable is what we owe our vendors. How does that liability go down? Well, accounts payable or that liability will go down when we pay our vendors, which requires a use of cash. This also means that if accounts payable were to go up, since it's a liability or equity account, we would assume that cash goes up. To summarize our cash flow rules, whenever our liabilities or equity increase, we treat that as a source of cash. And if liabilities and equity were to decrease, we would say that is a use of cash. Let's move ahead and take a look at some asset accounts. Let's begin with equipment. If equipment goes up, notice on our cash flow statement we have a negative sign up here, which means that if equipment or an asset goes up, our cash will go down. Let's consider another asset, inventory. Again, if an asset goes up, we assume we bought an asset and our cash goes down. Conversely, if equipment or inventory went down, the assumption is that we sold an asset and we received cash. Let's consider another asset, accounts receivable. Our accounts receivable goes down. That means we've collected money or cash from our customers and our cash would go up. And of course, the opposite of this then would have to be true, that if accounts receivable goes up, our cash goes down. That may seem a little strange, but again, just consider it an asset. When we purchased inventory and equipment, we said our cash went down. So accounts receivable is just another asset. And when accounts receivable goes up, we'll assume our cash goes down. To summarize our cash flow rules, an increase in our assets is considered a use of cash. We bought assets, our cash goes down. A decrease in our assets, we sold assets, and we consider that a source of cash. Now, some of our changes were pretty straightforward. For instance, the increase in loan means we got cash, and the decrease in loans means I paid cash. On the other hand, several of the accounts we put up here might have seemed somewhat confusing. The ones I always found were confusing was that an increase in accounts payable means cash went up. I'm not sure I see that. Likewise, an increase in accounts receivable means that cash goes down. I'm not sure I see that one either. An important thing to remember, though, is don't try to remember the confusing ones, or you will be confused. Try to remember the ones that make sense to you. Remember the easy ones. Loan goes up, I have cash. Equipment goes up, an asset goes up, means I spent cash. So again, don't try to remember the confusing ones or you'll be confused. Stick with several of the easy ones. Loan goes up, I got cash. Asset goes up, I had to spend cash. And life will be a whole lot easier. Let's go ahead though and see if we can get some deeper understanding. Let's consider the purchase of inventory on account. When we buy inventory on account, this is our journal entry. Inventory goes up and accounts payable goes up. Notice, this transaction doesn't involve cash. Let's look at the impact on our accounting equation and our cash flow statement. The increase in inventory, whenever we have an increase in assets, we assume cash goes down. On the other hand, when we have an increase in liabilities or equity, we say cash goes up. And notice, there's no net change in cash. Now let's go for an even deeper understanding. Consider a sale on credit. Our journal entry would be a debit to accounts receivable and a credit to sales. Again, the transaction does not involve cash. Let's look at the impact on the accounting equation. Whenever an asset goes up, we say cash goes down, so AR going up, cash goes down. And when AR goes up, we also had an accompanying increase in sales. Sales would have caused net income to go up, which would have made retained earnings and equity account go up. And whenever equity goes up, we would say cash goes up. So again, there's no net change in cash. It's the duality of our accounting system, debits and credits, and the fact that our balance sheet stays in balance means that we don't need to look at the individual transactions. We can look just at overall changes, and we know that the changes will cancel each other out if there's no cash involved in the transaction. So again, to summarize our cash flow rules, assets go up, we bought something, we've used cash. Assets go down, we sold an asset, we got cash. If liabilities or equity go up, someone lent us money or gave us money. If liabilities or equity goes down, we paid somebody back, and it's a use of cash. We're going to go ahead now and build a cash flow statement. We're going to make use of an income statement and also, more primarily, a balance sheet. Here's the balance sheet for the Belfry Company. Recall our 3 easy steps for preparing a cash flow statement. We're going to begin by calculating the changes in the balance sheet accounts for the Belfry Company. So we simply need to take the change between the first year and the last year, or rather, most recent year. Let's begin by looking at the change in cash. We've got a $400 change in cash. Accounts receivable has changed by $100. You really don't need to worry about whether it's an increase or a decrease at this point. We're just calculating the change. Inventory, a $1,200 change. Plant and equipment, a $2,000 change. Accumulated depreciation, a $500 change. Accounts payable, a $600 change. Accruals, $100. Long-term debt, $1,200. Common stock, $800. And the change in retained earnings is $500. Our second step then was to identify the source of the change as being related to operating, investing, or financing activities. Let's begin by considering the change in accounts receivable. Accounts receivable arises from our credit sales to our customers that we make on a day-to-day business basis, and it's an operating cash flow. Inventory, we're buying that for sale to our customers on a day-to-day basis. That's again part of day-to-day operations. Plant and equipment. Let's pause here and take a look at 2 brief rules associated with our cash flow statements. Recall, financing activities involve money we raise from investors or repay to investors. In other words, we're borrowing money, we're getting loans, or we're selling stock to investors. So they are supplying us with financing, and we would have an increase in our liabilities or equity. So whenever you see a change in asset accounts, we know by definition it cannot be a financing activity. Likewise, investing activities involve the purchase or selling of plant and equipment or other marketable securities. In other words, we are acquiring an asset. So our assets will go up. There'll be a change in assets. So whenever you see an account that involves a change in liabilities or a change in equity, we know it cannot be an investing activity. So let's go ahead and continue with the classification of our cash flow activities. Again, the change in plant and equipment we said would be an investing activity. In terms of accumulated depreciation, it's an operating activity. We're using the plant and equipment in day-to-day operations. The change in accounts payable is an operating activity. That's inventory we're buying on account. Our accruals relate again to our day-to-day operations. Our long-term debt, that's a financing activity. We have investors, or the public is giving us money. Our liabilities are increasing in the form of something where someone's expecting to earn a return. So we are raising money through financing activities. The same thing is true about common stock. And then finally, we're going to break our retained earnings, the change in retained earnings, down into two types of activities, operating and financing. Let's go ahead and take a look at that now. Here's our change in retained earnings. Our beginning retained earnings was $1,500 and our ending retained earnings was $2,000, hence the $500 change. That's going to be composed of two parts, net income and dividends. Recall we were given an income statement and we had net income of $1,000. Well, if our net income is $1,000, we can solve for the plug. In dividends, we obviously have to see is $500. And we'll classify the $1,000 change in net income as an operating activity and the $500 decrease in equity or the payment of dividends as a financing activity. Let's go ahead now and take a look at the third step in preparing our cash flow statement. We've calculated the change in the balance sheet accounts. We've identified the source of the changes relating to operating, investing, or financing activities, and now we need to simply decide whether the change resulted in an increase or a decrease in cash flows. By convention, the first item on our cash flow statement is net income. And recall, net income made equity go up. When equity goes up, we say that cash goes up. It's a source of cash. The next thing we're going to look at was our change in dividends, since we're picking up that $500 change in retained earnings. And our dividends we classified as a financing cash flow. Dividends make equity go down, and we would say our cash went down, and we have a decrease in financing cash flows related to the dividends we paid out. By convention then also, the next item on our cash flow statement is typically the change in accumulated depreciation, and we simply label that as depreciation expense. Now in this case, notice our accumulated depreciation went from $1,000 to $1,500, and accumulated depreciation makes our assets decrease. So if we have a decrease in assets, we can see that we would say we had an increase or a source of cash. After we pick up the change in depreciation or accumulated depreciation, let's go ahead and work down our balance sheet. Accounts receivable is next. We had a $100 decrease in assets. And when assets go down, again, the assumption is we sold our assets and we received or got cash. Next on our balance sheet is inventory. Inventory increased, and when assets increase, we say we purchased the inventory, or we would say we had a cash outflow of $1,200. Plant and equipment was classified as an investing activity. And again, the increase in assets, we bought an asset, obviously our cash had to do what? Go down. We've already picked up the change in accumulated depreciation, so let's move down to our liabilities and our equities. Accounts payable, it's a liability. Our liability goes up. We said that is a source of cash, just like a loan. Someone gave us cash. Our accruals, that was a liability that went down. How do liabilities go down? It's a use of cash, and again, an operating cash flow. Long-term debt and common stock are both financing activities, and in both cases, long-term debt went up, so liabilities went up. It's a source of cash. And the increase in common stock is also a source of cash. We've picked up all the changes in our balance sheet accounts, and so now we want to check and confirm that this does indeed equal the change in operating cash flows. If we add up our operating cash flows, we see it totals to $900. Our investing cash flows is a $2,000 cash outflow. Our financing cash flows is a $1,500 cash inflow, giving us a change in cash of $400, which agrees with the change in cash that we're trying to calculate. But to confirm, let's go ahead and pick up our beginning cash balance. Our beginning cash balance is $1,000, plus the $400 change in cash should equal the $1,400 change in cash on our balance sheet. So to recap, first calculate the change in all and only our balance sheet accounts. Now again, we picked up net income and dividends, which don't show up on the balance sheet, but together those account for the change in retained earnings. Next, identify whether the change resulted in an increase or decrease in cash flows. Whenever an asset went up, we said we purchased the asset and cash went down. Likewise, if an asset went down, we sold it and cash went up. And we had also had our rules for liabilities and equity. Liabilities and equity go up, cash goes up. We got a loan. Someone gave us money. If liabilities or equity goes down, we say cash goes down. We return the money. And then finally, we also had to identify the source of the change as relating to operating, investing, or financing activities.